Welcome to the Real Estate Syndication Show. Whether you are a seasoned investor or building a new real estate business, this is the show for you. Whitney Sewell talks to top experts in the business. Our goal is to help you master real estate syndication. And now your host, Whitney Sewell.
I want to tell you about an upcoming real estate investing conference hosted by my good friend, Joe Fairless. Every February, Joe brings his best ever conference to Denver, which brings together the top high-level experienced real estate speakers and sponsors that has proven to be the best ever networking, content, and strategies to help grow your portfolio. The earlier you buy, the more you save. Ticket prices increase weekly, so you want to buy today. I attended in 2018, and I can guarantee you do not want to miss this conference. February 22nd and 23rd, 2019 in Denver. Go to besteverconference.com to reserve your seat today. That's besteverconference.com and use hashtag Whitney to save 10%. That's hashtag Whitney.
This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, our guest is Joseph Gozlan. Thanks for being on the show, Joseph.
Thanks for having me.
Yeah, it's a pleasure to have you. Joseph is a multifamily investment specialist, a commercial real estate problem solver, public speaker, and published author. A strong multifamily operator with experience building a portfolio of over 260 units. And Joseph, give us a little more of your background, how you got into real estate and specifically the syndication business.
Yeah, so I go back with real estate all the way to '05 before I even come to this country. And I was born and raised in Israel. I went through the usual course of back home, everybody go to the military. I was a lieutenant. Then I went to engineering school. And I got my degree and worked in IT for a long time, which helped me relocate to the United States. But I've always had that passion for real estate. That's always been our investing strategy. And then we started with singles and then eventually graduated to multifamily. And then to syndication, I got to because honestly, I ran out of capital, right? So if you really want to get into multifamily, it requires a lot of capital. And there's not a lot of people that can just continuously deploy capital endlessly. So the next best thing is to bring in a few partners, and that's how we ended up doing syndications.
Nice. And I've heard that happen, obviously, to many people, right? You know, they start single family because they feel like that's where everybody has to start. You know, they have this mental block of that's just that's how you have to do it. And then, they run out of capital. So they search for a different way, and then it leads them to syndication. So what was it that said, okay, I know, multifamily syndication, or are you focused on multifamily completely?
Yes.
Okay. So why multifamily and not self-storage or not, some other asset class?
Yeah, good question. When I started my graduation process, right, quote unquote, going from the singles to the commercial world, I looked at all of it. I looked at retail and medical and office and self-storage and land and you name it, I looked at it. And for me, multifamily is the strongest asset because of a few factors, right? One, we're in the middle of a huge generational shift, right? You have 75 million baby boomers just scaling down. They don't need a big house. They don't need the utility bills. They don't need the property taxes. They don't want to deal with cleaning gutters and mowing lawns. They just want to be able to pick up the phone and tell somebody, hey, my dishwasher is not working, send someone to fix it, right? So that's 75 million people. You have 77, 78 million millennials, which for their reasons prefer to rent over buy, right? They either in huge student debt, or some of them have been traumatized back in 07, 08, looking at their parents losing jobs, losing homes. Some of them just like the lifestyle of being able to move around, going to where the hype is, to where the jobs are. Whatever their reasons are, they're a different generation and they prefer to rent over buy. So you combine these two, you have over 150 million people that have a strong preference to rent over buy. So multifamily made the most sense. It's not going anywhere. It's also, in my opinion, one of the hardest asset class to disrupt, right? You look all around you, Uber disrupting the taxi industry and Netflix disrupted cable. And there's so many disruption that technology comes in and change things around. But it doesn't matter if you walk to work or drive to work or fly on a helicopter to work, right? You still need to come back home and go to sleep, right? People still need shelter. People still need a place they feel is their own, to put their head on the pillow at the end of the night, right? So that's why I think multifamily is one of the safest assets to look at.
I like that. I like that you said that, the hardest class to disrupt. I haven't heard anyone say it like that. So, moving from single family, I think you can speak to a lot of listeners who are in that same position that you were. Maybe they've had many single family homes, but they want to get in the syndication business. What are some things you would advise them to be doing, to really give them the confidence to say, okay, I can do this. I can go do that 100. I can look at that 100-unit apartment complex.
Yeah, so let's start with me for a second, right? The reason I started with single family is not because I thought that I had to. Honestly, it's because I didn't know anything about multifamily, right? We didn't have all the podcasts and the bigger pockets and all the internet information that just explodes today, and you just click on something on Facebook and you have all that information in front of you. We didn't have that back in 06, 07, 08, right? So that's, for me, it was just ignorance. If I knew, right? You always look at things and you say, oh man, if I could go back in time and talk to myself back in 08, what would I say, right? So let's take aside the fact that, everybody want to tell yourself, this is the bottom, buy whatever you can, right? Put that aside for a second. I would tell myself, skip the single family phase, just go straight up to multifamily. And it's a perception thing, right? But in reality, multifamily, a 100-unit multifamily property is a safer investment than a single family, right? And just looking at it from the risk perspective, if you have a single family and your tenant moves out, then you're 100% vacant. The money for the mortgage is going to come out of your own pocket. The releasing fee that whatever agent is going to charge you comes out of your pocket. You pay mortgage, insurance, utility bills. And if that previous tenant didn't keep it top shape, you're still going to have to come in and do something, right? Paint, floors, fixtures, whatever. So you carry 100% of the risk. You put a mortgage with your personal name on it, right? And this is 100% of the risk. Versus if you look at a 100-unit property, you can have 10 of them vacant. You'll still have money to pay the mortgage, still have money to pay salaries, maintenance, even pay your investors if you underwrote it correctly, right? No risk. There's no risk for you to cut a check out of your own pocket to cover this thing. So that's why for me, it's a no-brainer, right? If you feel uncomfortable, just look at the numbers. The numbers don't lie. The numbers show you this is a safer investment than a single-family property. Yes, there's a few more zeros, but look at it from the risk perspective, it's lower risk.
So what's been the hardest part of the syndication business or process for you? And maybe you could even say, maybe the first syndication deal that you did compared to maybe the most recent.
Yeah, absolutely. So I had two major insights come out of my first syndication attempt. I did everything soup to nuts. I built a relationship. I sourced the property. I underwrote it. We did due diligence. I got it under contract, negotiated, talked to lenders, raised the equity. I've done everything. So the first major insight was never do that again on your own. It was just a lot of work and a lot of stress and a lot of impact on my family, my time, right? And I was also full-time employed when I did that one. So that didn't help either. But it was just a lot of effort and a lot of stress that I wish I had the ability to share that with another person, right? So that was my first insight. And every syndications I've done since then, I have a very good business partner that we're working together on. My second insight was don't wait until you get the property under contract before you start telling people you're going to have an opportunity for that, right? Because by then it's what adds and exaggerate your stress levels. Because now you're going to have 30, 40 days, maybe 45, if you're lucky, to talk to people educate them about what is multifamily, educate them about what is private offering, and then educate them about this opportunity, and then educate them why they should invest with you, right? And that's just a lot of changes and a lot of materials that a person would have to absorb in 30, 40 days. So my second insight was just start telling people as soon as you can about what you're doing. Tell them that you're going to do multifamily, even if you haven't done a single deal, right? Tell them that you've done multifamily. Tell them that you're going to do multifamily. Tell them what it is. Tell them why you chose this asset class. Show them a sample deal, right? Even if it's fictional, just show them something, right? Get the education process and the familiarity a lot sooner than actually having a property under contract. One caveat, don't take a single dollar, right? Nobody wants to mess with the SEC.
Right. So what you talked about your team, your partner, what are your all specializations? What do you do in the business compared to what he does now that you're not doing everything now, yourself, like you said. So how have you split those roles up?
Yeah. So really, if you look at a syndication lifestyle, right, you got to source a deal, underwrite it, put it under contract, due diligence, secure financing, raise equity, transition rehab, and ongoing management, right? So it's important that you find a business partner that complements your skills and not has the exact same skill set, because you'll just end up stepping on each other's toes and still be weak at the places where you're weak, right? So my business partner is stronger on the equity raising side, and his network is very wide. So we tap into those. I still do a lot of the equity raising activities myself, but it reduces a lot of stress when you can tap into a very big network like he has. And he also does a lot of the raising activities himself, which obviously takes the load off of me.
Nice.
The operation side, it's still on me.
So what, are you doing the underwriting?
Yes, I do.
So tell me maybe how, the underwriting has changed just in your experience from, a few years ago to maybe in today's market.
Yeah. So really what I've seen, and this is another tip for somebody that wants to get started, is whatever somebody showed you how they underwrote it 4 years ago, you cannot keep going forward with that, right? We've been on the, like people say, the ninth inning for the last 3 years, right? Everybody knows that we're very much at the top of the market, whether we have a little bit more run or whether we already passed the top. Nobody has a crystal ball, right? But everybody agrees that it's somewhere within the next 24 months, the market is going to shift. So what you really have to do when you underwrite properties these days is take that into account. Take that into consideration. Stress test your underwriting, right? So if the market occupancy in that area is 95%, how does that purchase look like if it's dropping to 90? What if it drops to 85? Right? What if it drops to 70, right? Find your break point to understand, okay, how worse can it get before I'm going to start losing money, before I have to call my investors and asking them to put money into the deal, right? And then everybody has a different risk tolerance, right? Let's say your break even is at 75%. Is that risky or is that comfortable? Everybody has their own decision. Everybody has their own, I call it risk muscle, right? And they can decide if it's too much or if it's okay for them. But if you're depending on a property to be 95, 96% occupied, I would think about it twice these days, right? If you cannot make your debt payment below 95% occupancy, you will get in trouble guaranteed in the next 2 years, right? So that's really where you got to stress test all your assumptions, stress test all your underwriting, and just look a little bit forward, and not everything is going to be rainbows and lollipops forever.
Are there other issues or problems where you see, big mistakes made in underwriting? Obviously not stress testing, the underwriting, but what else can we do to make sure our underwriting is as solid as possible, with today's market?
Yeah. So one of the big mistakes I see out there happens both from brokers and from buyers is not considering an increase in taxes, for example, right? Whether if you're in a disclosed state, right, where the sale price has to be disclosed, then you can absolutely 100% guarantee that the next time the property is going to be assessed, your taxes are going to match your new purchase price. Right? And it's very simple. You just go to the county website, you find that coefficient, and you apply it to your purchase price. Some counties actually let you have a calculator to help you calculate what it's going to be based on the new purchase price. And you better plug that number. You cannot plug the seller's number. That's not going to work, right? If you're in a non-disclosed state, like Texas, for example, then it depends on the county. Some counties are more aggressive than others, right? If you were to buy in Dallas or Collin County, I would go 95% of purchase price. They don't have a way to figure out how much you paid for it because it's all confidential and you don't have to disclose. However, you record the note, you record the loan. They're not stupid. They can see immediately that it's somewhere in a certain range based on 75% loan to value, 80% loan to value, right? They'll figure it out. So that's really where you got to be careful with these things. And this could be a significant jump in expenses. We can talk about hundreds of thousands of dollars a year difference. So that's the biggest mistake I've seen buyers and some newer brokers do when they don't calculate that into their underwriting. Nice. The other big mistake I see is blindly taking the seller's numbers. And, you know, I'm not talking about the fact that I've seen multiple offerings and T12s that the rows don't end up with the totals, right? They don't sum up to the totals. I've seen sellers fudge numbers. I've seen brokers fudge numbers. I've seen everything out there. But just think about it from the perspective of what the seller can get might not be what you can get, right? If you're if the seller's brother-in-law is the guy that does pest control and he gives it to him at cost, you're not going to get that, right? And on the other side, if that seller has the same manager for the last 20 years and he's been inching up their salary every year, so now they get, I don't know, $90,000 a year for a 40-unit property, you're not going to pay that, right? So that's why looking at the seller's number is a good reference, but you better know your own numbers and what you can get and what you're going to pay, because otherwise your underwriting is based on some random assumptions.
Have you heard of the Multifamily Investor Nation Summit coming up on January 17th through the 19th? It's a 3-day information-packed event for multifamily investors with over 1,000 attendees and over 50 speakers. You will hear from experts about finding deals, raising capital, underwriting strategies, selecting markets, and so much more. I have also been invited as one of the speakers to present on creating authority platforms like podcasts. Go to apartmentevent.com to grab your ticket and use promo code Whitney to get $100 off. Whether you are new to multifamily investing or a seasoned investor, you do not want to miss this event. Start 2019 off right by joining me at the Multifamily Investor Nation Summit. Visit apartmentevent.com and use promo code Whitney.
Give us some details or an overview of maybe the last syndication that you all did.
Yeah, so we just purchased a 236-unit property in Lubbock, Texas. It was just an off-market opportunity where we were working with a broker relationship that we have, and he was able to bring this thing completely off-market to us. The sellers were not even convinced that they want to sell, and we just came in and we put in an offer. There's a lot of deferred maintenance. We have over $1.5 million in budget on that one for the rehab. And we raised about $3.3 million for that one.
Nice. Tell me how you created that relationship with that broker. You know, a lot of people want to find obviously those off-market deals, right, and establish those relationships. What are some things that everybody could apply to their business so to develop those relationships?
Yeah, so really, and this is where I can give us a little sneak peek from the behind the scenes, because I'm a broker too, right? We focus on multifamily as well. And still, I'm working with other brokers. And when I work with another broker, I tell them, look, I'm a buyer. I'm not looking to share commissions. I'm not looking for anything. I'm just going to be a pure buyer for you. And the point is really, commercial brokers do maybe 2, 3, 4 deals a year, right? Some stellar guys do more, but for the most part, they do 2, 3, 4 deals a year. And don't cry for them. These are 6-figure income, every one of them, right? So their goal is to make sure that whoever the buyer is, it gets to the closing table. The seller wants the minimal disruption to the property. And he requests from brokers, he asks us to vet the buyer as much as we can, because he also wants to get to the closing table with a minimum amount of disruption. And these deals can take 35, 40, 60 days, 90 days. I've even seen bigger ones that go for over a year. So you're going to disrupt the property for so long. You're going to lock the property off the market for so long. You want certainty of close. And this is where a lot of the new guys are going to hit a wall when they talk to a broker, because if he's not sure they're serious, if he's not sure they're not a tire kicker, then he's going to go to the next guy. And as a broker, if, I don't know, I have a listing at $5 million and I have a buyer that is a first-time buyer offering 5.1 and a guy that already owned 3,000 unit offering 4.9, who do you think we're going to recommend the seller to go with? But ultimately, it's the seller's decision, but the certainty of close is dramatically higher on the guy that owns 3,000 units already, right? So that's really where it is. Your goal in that relationship building is twofold. One, make sure they realize that you're not a tire kicker, that you're serious, do whatever it needs to do, right? If you need to show them bank account balances, if you need to show them experience, if you need to show them other relationship, like partners that have experience, whatever you need to show them so they'll know you're serious. And the other thing is stay current with them, right? So I have hundreds of buyers in my database, right? When I get a listing, who do you think I remember? The guy that filled up a form 8 months ago online? The guy that called me once a year and a half ago and I never heard from him? Or the guy that calls me every other week? It's that simple.
Right.
So if you stay involved, you stay on top of them. It's kind of like, hey, how's it going? Checking in. Do you have anything coming down the pipeline? You'll more than often hear, oh yeah, I got this thing I'm working on. It's not ready yet, but, and that's the beginning of getting that off-market deal.
So being a broker also, I hear a lot of guys that want to get into the industry or, be a syndicator, but they think, should I, they want to be a broker also, or they think that's an avenue into the business. Would you recommend that from your experience?
Yes and no. So 95% of the brokers out there are not owners and not operators. So that's really where you got to figure out where you want to go with that. We actually have 2 separate businesses, and we have agents and we run the brokerage side and we run the acquisition side completely separate. There's complementary there, right? So if we get a chance to help a seller that needs to buy to exit fast, or if we help one of our properties that we bought, we help the group sell it. That's complementary, but it's 2 different businesses. And if you are not going to be focused on building another business, there's not going to be a point of you joining the industry as a broker. That's one thing. The other thing is most of the new guys go to companies like Marcus and Millichap and ARA and CBRE, and these big corporations have rules against you buying anything. So if you're thinking that going to Marcus and Millichap is going to help you buy, you're going to find really fast that the corporation doesn't allow you to do that. Wow.
That's some good information right there. That'd stop you in your tracks if that was your goal, wouldn't it?
Yeah.
So this property in Lubbock, it's a big renovation, $1.5 million for rehab, and tell me how you structured that deal and the holding period, and tell me a little bit about that.
Yeah. So this one we did a little bit different than our usual agency debt. We took a bridge loan on that one, and then within about 2.5 years, we plan on going to HUD loan. And our hold periods are usually 7 to 10 years. So we have that length to be able to take on that HUD loan. Obviously, we're going to improve the rent and improve the property and all that in the process.
So I guess tell the listener what, real briefly, what a bridge loan, what a HUD loan is and the difference.
Yeah, absolutely. So a bridge loan is something that you get for anywhere between 12 and 36 months. It's interest only, and it's a financial product designed to be closed fast. It's a bridge loan. That's where the name came from. So it bridges you to a permanent debt. When you get to a permanent debt, there's a lot of options out there, but the most common ones are what I mentioned earlier is agency debt. And this is where you have Fannie, Freddie, and HUD are the major players. And Fannie Mae loan and Freddie Mac loan are usually anywhere between 7 and 12-year term with a 30-year amortization and great rates. A HUD loan is actually a little bit better because it's 35 years fully amortized loan, and they're usually about 3/4 of a point to a full point below the other two agencies. So it's a fantastic loan to have. The downside of a HUD loan is that usually it takes anywhere between 6 to 10 months to get it closed. And there's a lot of process and inspections and annual reviews and so on that comes with it. So you're going to pay for that better loan in the long run. But a 35-year fully amortized loan is something that's really hard to get. And in a seller's market, there's no seller that is willing to wait that 6 to 10 months, right? So every HUD loan that is being taken these days is usually bridge to HUD.
So speak to the person who's nervous about a bridge loan right now, just because of the market. How do you answer those questions, when somebody says, well, wait a minute, Joseph, a bridge loan, I'm a little nervous about a bridge loan right now with the market the way it is.
Well, they should be. That's okay. Being nervous doesn't mean you don't take action, right? Being nervous means you build plan B, and being nervous means that you underwrite correctly. So for us, the bridge loan, we already went to HUD and got a quote on the purchase price that we just paid. So I know that worst comes to worst, I'll be able to get at least what I just paid. So this is my safety there. Now, hopefully, of course, we'll get extra proceeds so we can distribute back to our investors. And that's the nice to have. But when we underwrote this and when we projected returns to our investors, we didn't even put that into the equation. We assumed that we're going to refinance and we're going to get the cost that we just purchased before all the improvements. This is how I hedged the bet against, well, what's going to happen in 2 years? What if I'm trying to refinance and the market is softer? Right. So that's one way to hedge. The other thing is this is a bridge loan, not a hard money loan. And I know a lot of the single family will think, oh, bridge is HUD because it's temporary. Bridge is hard money because it's temporary. And no, when you get a certain size, those bridge loans have terms that are very, very similar to permanent debt. Right. So we paid LIBOR plus 325, which puts us at the 5.2, 5.3%, which was about 1/4 point away from regular agency debt. So we're not getting any crazy rates. We don't pay a lot of interest. We pay normal amount of interest. I understand that there is nervousness, but there's also numbers. Work with the numbers. Hedge your bet against the market going soft. You should be fine.
I really like that quote. Being nervous doesn't mean you don't take action. I really like that. So you find another way, right? You make it happen. So I really, really like that. So what would you say is the number one thing that's contributed to your success, Joseph?
Two things. One is I'm very, very creative when it comes to putting things together. And that's just one of the things I love about the real estate industry. It's kind of like there's more than 9 ways to skin the cat. So we always find a creative way to work through things. And then the other thing is just perseverance, right? Life will throw at you whatever life can to throw at you. You just got to persevere through everything. You got to work your way through the challenges. There will be challenges. It's not going to be rainbows and lollipops. It's not going to be awesome, right? We had a property, our first syndicated property, a year into our ownership, we had a water heater go out. It was a 2-year-old boiler when we bought it. 3 years after, it died right out of warranty, of course, right? $25,000 expense. It happens, right? You just got to have to figure it out and work through it. You got to plan for it. You got to build your CapEx budget, right, in that specific case. But the point is that you got to persevere through it. You got to push through. And if you push through, you'll be fine on the other end.
What's some way you've recently improved your business that we could all apply to our business?
That's a good question. We just implemented customer surveys. So we bypass the property management company that we're working with, and we go straight to the resident and we send them surveys, right? We use an online system and we get feedback and we share that feedback with the team. Right? And we try to help our team to understand that this is not a slap on the wrist or anything else. Just statistically, it's the more vocal voices will be the people that are not happy. Right? The people that are just happy and content, they're not going to bother clicking a link and spending time on running a survey, right? Yelp is the best example, right? Just open Yelp. There's a lot more negative reviews than there are positives. But it also helps us keep an eye on the friendliness and the openness and the level of treatment that our residents get from our staff. It helps us. I'm not on the property every day. I don't know if it's dirty or if they clean up every morning like they're supposed to, right? So if I get comments like it's dirty or the laundry machines are not working or whatever we get in that feedback, I'll be able to turn that issue and get it corrected a lot faster. So that's one thing that we just recently implemented and we were very happy with.
Nice. Well, Joseph, we're out of time, but you've been a fabulous guest, and I appreciate all the content you've provided and value to the listeners. And would you tell them how they can get in touch with you or learn more about your business?
Yeah, absolutely. The easiest way is to find our website, ebgtx.com. It's just 5 letters. And then you can find my email and my phone number over there. I'm very approachable. I'm on Facebook, LinkedIn, Twitter, Instagram. You pick one, I'm there. But ebgtx.com is the easiest way.
Nice. Thank you so much, Joseph, again. And I hope the listeners learned a lot, and I hope you'll connect with Joseph, and I hope you'll reach out to me on the website and schedule a call so we can figure out how to help you the best, in your syndication journey. And I hope you'll join on the Facebook group so you can keep learning from experts, and we can all learn together from experts like Joseph on there. And we will talk to you tomorrow.
Thank you.
Thank you for listening to the Real Estate Syndication Show, brought to you by LifeBridge Capital. LifeBridge Capital works with investors nationwide to invest in real estate, while also donating 50% of its profits to assist parents who are committing to adoption. LifeBridge Capital, making a difference, one investor and one child at a time. Connect online at www.lifebridgecapital.com for free material and videos to further your success.